For this mock exercise, we're going to take a look at variance analysis. In particular, we're going to take a look at direct materials, direct labor variance through a case called Shona Shawls, Smart Shawls, Inc. And in this exercise, we're also going to take a look at the journal entries. How does this affect the journal entries of the books and records of Shona Smart Shawls, Inc.? So let's take a look at the question. So let me enlarge it for you. Okay, so the question goes like this. Shona is a small business, and they developed while she was in college. She began the hand knitting shawls for her dorm friends to wear after studying. As the demand grew, she hired workers and began to manage the operation. Shona Shawls requires wool and labor. She experiments with the type of wool that she uses, and she has a great variety of shawls she produces. Shona has a bimodal turnover in her labor. She has some employees who have been with her for a long period of time, and others are new and inexperienced. Shona uses a standard costing. For her shawl, she expects that a typical shawl should take 3.5 hours to produce. So these are what we call the standard. So these are the standard number of units for each input for each one actual output. So it says that it requires 3.5 hours to produce, and the standard rate of wage is $10.50. The average shawl uses 12 skins of wool, and Shona shops around for a good deal and expects to pay $3 per skin. So that's the standard material and standard labor. Now, Shona uses just-in-time inventory, and she has a client that tells her what type of color and wool that she would like to use for the month of April. So now we're dealing with actuals. Shona's worker produced 230, so these are the actual output, using 836 hours and 2,633.5 skins of wool. These are the actuals input. She bought wool for $8,295, that's the actual cost, and incurred labor for $7,814.50. So the first part is asking us to calculate the price and efficiency variance of the wool and the price and efficiency variance of labor. Then it's asking us to do a journal entry. Okay? So that's what we're asked to do. So let me start with solving the problem. Okay? So I like to use the column approach for variance analysis. And the first one is direct materials. So the first column I want to do is I want to know what was my actual materials used. So we know that we were given that number, right? So these are actual. We were given, that's the cost of materials. That was given to us. So let me put that down. Okay, so actual cost incurred. So that one is $8,295.50. I'm going to put the word G beside it to show that it is a given amount in this question. Now, we need to create what is the flexible budget. And flexible budget means, okay, standard input times actual output. So standard input allowed for actual output. That's what a flexible budget is. So the number of units is important, the actual number of units that produced. Now we said that we made 230 shawls. Okay? Now, what was the standard input for each one of those shawls? We were told that each shawl requires 12 skins of wool, and the standard is $3. So that's what we want to do. You want to know that there's 12 times $3. And that gives us $8,280. So flexible budget is meant to showcase the standard input allowed for the actual output. We made 230 actual output, but we want to know the standard formula to make each shawl. Okay? And the difference between these two is what we call the flexible budget variance. And the difference is, this is 8295 minus 8280. It's $15.50. It's unfavorable because we spent more than what the actual standard for those number of units produced. Now, to make this analysis much more intuitive, we need to break out between this variance into price and efficiency. And price is all about the difference between the actual price of these wool versus the standard price. And efficiency is all about the number of pieces of wool that was used in the actual production as opposed to what the standard calls for. So for us to be able to figure out the price and efficiency, we need a third column. And that third column is actual input quantity times budgeted price. So what we want to do is we want to isolate the difference in price. In this case, what was the actual input, the actual quantity input? We were told that she used 2,635 skins of wool. That's the actual number of skins of wool that she used, right? So it's going to be 2,633.50 times the budgeted price of $3. Okay? So now what we're going to do is we're going to say the difference between these two, okay, is going to be $395. And it says unfavorable, favorable. It's going to be unfavorable because the actual cost, the rate is probably higher than the budgeted. Now, how do we determine that? We can re-engineer the actual, couldn't we? We know that she used 2,633.50 skins of wool. The average price must be, take 8295.5 divided by 2633.50. You can see that the cost is $3.15. And you can see that the cost is much higher. That's why we have an unfavorable, and this is called price variance. Now, we want to know the efficiency variance. The difference between these two means that, check this out, how many skins of wool did we actually use? It's going to be 230 times 12. So this is 2,760 skins of wool. We used 2,633. So we have a favorable variance. And that favorable variance, the difference between this number and this number, is 379.50. Why is it favorable? Because I end up using less number of wool material, and the commonality is the standard price, the budgeted price. So the sum of these two should equal the flexible budget. That's how we do the variance analysis. Now, we're going to do the next one. We're going to do direct labor. Exactly the same way as we did the materials. So first, we want actual cost. What was the actual cost of labor? We're given that amount again. So we were given actual cost at 781450. What was the flexible budget? And what was the flexible budget again? Is the budgeted input allowed for actual output. Right? So this is the standard or budgeted input allowed times actual output. So, what was my actual output? 230 shawls. What was the budgeted input for each shawl? How many number of hours of labor we should have incurred on a standard basis to make that one unit of product? We're told that it takes us 3.5 hours to produce one shawl and a cost of $10.50. So 350 times $10.50. It's 8452.50. So when I look at the difference between these two, this is called my flexible budget variance. And that is, again, the difference between these two is 300 or 638. Is it favorable? The answer is yes, because I spent less than what I budgeted. Once again, I need to split this flexible budget, 638, into price or rate in this case, the labor rate. Is it because of the rate that I pay these employees, or is it because I end up using more hours to produce this labor? So I need a third column, and the third column is actual input times budgeted price. Again, let's think about that, right? What was the actual input? How many hours did I end up using? I used 836 hours. So 836 times the budgeted rate, which is 1050, to give me 8778. So the difference between these two is going to be what we call the price. Now again, we don't know what the rate was, but we can figure it out, couldn't we? By taking 836 hours times the rate to give me the 7814, because this is the actual cost. So we need to know what was the real rate that we paid our employees. $9.35. You could see that we paid the employees less. So we must have hired more inexperienced people at a lower cost. So this explains why we have this favorable variance. Part of it is price, and that is $963.50, and that's a favorable variance because if you look at it, I paid less in rate, isn't it? But then I look at what we actually use, and this one is 230 times 3.5 per shawl. This is supposed to be 805 hours, but we end up using more hours than we should have. So this one is 325.5 unfavorable. So the sum of these two gives us a favorable variance of 638. So what's happening here is we end up using more hours, and it makes sense because we're having more inefficient labor, Because why? I'm paying the average labor rate I'm paying is less than what my standard rate is. So that implies you can only make these deductions, and intuitive deductions, that says you must have been hiring less experienced workers. That's why the average rate is lower. But check this out. You end up using more hours to finish one shawl or 230 shawls. That's because you end up using more inexperienced labor. So the sum of those two is going to be a favorable variance of 638. Now, second part of the question asks us to do a journal entry. Okay? The journal entry. So how do we journalize this? So let's take a look at the journal entry. So first of all, we're going to journalize the direct material. Okay? So first of all, we need to credit either accounts payable or cash. And we're going to credit the actual amount that it cost us to incur. That's $8,295.50, correct? Now, how much are we actually? Now, you have to assume when we're doing this using standard, we're going to record the work in progress. We're going to record the inventory balances based on a standard amount. So what will be our standard is we're going to debit the direct materials control account. And we're going to debit the control account based on the standard actual input by time standard price. So I want you to imagine these employees would have time cards and we would have to pay them. And when we pay them, that's a credit to either accounts payable, or in this case, not time cards. There would be the number of materials that we would take out of the raw materials account. We would only track the number of pieces that we use to make these shawls. And we know we're going to use a standard price. Because you're going to imagine, Shauna's going to be buying these pieces of wools at different prices. So we're going to let the accounting inventory system deal with that. But as far as we're concerned, we're going to charge a standard price. So that's why we're using this column, the actual input times budgeted price. Now, what happens, these two don't balance, so you're going to have a debit called direct material price variance. These price variance, this account is a temporary account. And what happens to these accounts is they're going to be closed out to cost of goods sold or finished goods, cost of goods sold, or work in progress. So there are two options to record them. Okay? But so this is only a temporary account. Now, let's deal with the efficiency variance. So again, what are we doing here? We're going to, first of all, we're going to close out, right? We're going to create a debit to work in progress because finally it's all made, right? The 200 shawls, we should have taken only 12 skins of wool at $3, so we're going to debit the work in progress. That's 8280. Keep in mind that that's what we're going to debit the work in progress at standard cost. We're going to credit the direct materials control account, because again, this is only a temporary account. So this is the amount here. And the difference is going to go as a credit to direct material efficiency variance. And that would be $379.50. So this is now, if you look at these two entries, this is canceled now, right? So that's effectively canceling that. So all we have left then are the variances, correct? So what are we going to do? We're going to close out these variants probably to cost of goods sold. So we need a third entry, don't we? And the third entry is going to be a debit direct material efficiency. We're going to credit direct material price because these are temporary account. And the reason why we record these is that this is a management tool. Because I want you to imagine that this is just month one of Shaw's, right? Of this company's, Shauna's operation. So I want you to imagine there are multiple entries to go into the efficiency and the price variance. And this is allowing management to then look at how much efficiency, how much price variance are we incurring. And this allows us to then evaluate the purchasing manager's performance or the production manager's performance with respect to how efficient or inefficient they are in producing these products. Now this one, we're going to credit $395. And the difference is going to be a plug, and it's going to be an unfavorable $15.50, and that is a debit to cost of goods sold. Because I'm assuming all of these products are sold. If they're not sold, they will be debited to finished goods, right? Okay. Now obviously this will go to finished goods as well, wouldn't it? We would sell it, right? Now, when we're dealing with direct labor, what happens? Well, we can certainly, you would argue we can pull these together as one entry, right? Correct? To me, you could do these in one entry, and we're going to do that too for direct labor. I'm going to show you the direct labor entry. So first, we're going to record the credit to cash or wages payable for the actual amount. That one we do know, right? Because that's the actual, isn't it? So we're going to credit wages payable or cash What is the debit to work in progress? The debit to work in progress is going to be the number of shawls that we completed times the standard input for all of the labor hours. So it took us, supposed to take us 3.5 for every shawl at $10.50. So that would be a debit to 8,452.50. Then we're going to record a variance analysis. If it's favorable, what do we do? Is it a debit or credit? It's going to be a credit. Why? Because we spent less than the standard. If it's unfavorable, it will be a debit because these are expenses. So we're going to debit direct labor efficiency variance, and that is $325.50. We're going to credit direct labor rate variance, $963.50. And that's the series of entries regarding standard. Now, part 3 asks the question, discuss the logical explanation to why these variants exist. I think I've done that already through the analysis of this variance. Thank you.